what you need is you need to now get help paying it off, because the average person takes 25, 30 years to pay off their home off. And what we want to do is we want to help you pay it off quicker. So if you want to get it paid off quicker in 7 to 12 years, then this is what you need to do. What you need to do is you need to get help. And the best way to get help is get multiple investment properties. If I own my home, how much equity should I pull out to use to invest? Okay, I'm happy to answer this one. As much as you can, whatever the banks let you do, right? What we want to do is your equity is literally sitting there doing nothing, right? There's no benefit in having equity, but you can actually use it. It's a bit like if you're going to the gym and you're bulking, you can't shred at the same time because it's not going to work. You're either bulking or you're shredding. You can't do both. So when you're accumulating property, don't worry about paying off your loans because your properties are going up and inflation's shrinking the loans anyway in the meantime. And I'm like, I'm going to help you get into that, but good debt, right? Okay, hello and welcome to Money for Life, your weekly dose of positivity and how to create money for life. Now, I'm joined with Adam Barclay from Well Street. Welcome, Adam.
Thanks, George. Appreciate it. Good to see everyone here.
Now, tonight we're going to be talking about finance because it's a big thing today. Everyone's talking about it, and we're going to talk about, are you paying too much for your mortgage and how we're going to find ways of saving you money. Not just a little bit of money, but thousands and thousands of dollars. And that's what it's all about. Because I guess there's two ways to make money. One way is making it, the other way is saving it, and they're both valid. And I think you need a bit of a project with a bit of both. Wouldn't you agree, Adam?
I would, yep. Very, very important.
Definitely. Before we start talking finance, what I want to talk about is the state of the nation and talk about what's been happening at the moment. So stop letting the banks win. Turn your debt into wealth and make money work for you. So look at this graph here. Now, this is the central banks around the world, because a lot of people are complaining about interest rates, but global interest rates are actually up and debt is very heavy, right? So look at this. Turkey, their central bank is at 46%. So if you're complaining about your interest rates here in Australia, imagine paying 46%. And you look at Argentina, 29%, Egypt, 24%, Russia, 20%. And you look where Australia is. We're actually just underneath the USA and UK at 3.85%. Now look at Switzerland, 0.25%. Imagine being in Switzerland and getting a loan for that. I mean, a license to print money. So if you look at the world stage, Australia's interest rates are not too bad. And the unfortunate thing is our inflation's been a little bit high, which looks like the RBA aren't going to give us our Melbourne Cup little reprieve, because they were planning on giving us a rate drop in November, but I don't think it's going to happen. What are your thoughts of that, Adam?
Yeah, I'd have to agree with you, George. We've seen just this week the RBA noticed that inflation's up. That's also something very difficult for them to have to manage over the long term. So, yeah, I don't think it'll happen this month. Possibly December or January, but we'll keep our fingers crossed.
Yeah, that's right. And the thing is, like, at the end of the day, if you're a smart investor, you're not going to rely on interest rates to dictate what you're doing, right? Interest rates is just one small piece of the puzzle. And the thing is, do we want low interest rates? Yes, we do. Because I love low interest rates, because when you have low interest rates, you've got better arbitrage. Because property, because what happens when what I talk about arbitrage is, if I can borrow money from the bank at 5%, but if I'm making 10%, then my arbitrage is 5%, right? And the arbitrage is really good. So what you've got to realize is when interest rates are high, arbitrage is higher anyway. So you look at back in the 1980s, was it 1980s when interest rates were like, and property prices were very expensive. It was around 20%, more than 20% some people. But what was happening is property prices were way outperforming that. So normally interest rates have got a lot to do with inflation, and the higher the inflation, the higher the interest rates to keep up the inflation. So when you're getting less interest rates, you've got less inflation, so you've got a little bit less growth. Now, there's more to the story than inflation, because property is its own beast And it's not just due to inflation, because when you look at the stock market and you look at gold, they're purely inflation driven. You have more inflation, they go up. When you look at property market, there's also a thing called a supply and demand. So regardless of inflation, there's a supply and demand curve which can push properties up and down. So that's what we're going to be considerate of. And at the moment, what's happening to property prices is insane. They're going up a lot because supply and demand is so skewed towards demand and not supply. You know, it's a seller's market. It's not a buyer's market. People are finding it hard to find property, very difficult. And, you know, especially looking at the top 100, we're finding it difficult. Like, it's a lot of work. Our team are really working hard to get those properties in. So considering we're not going to get a rate drop soon, and it may not happen till December or January, what are ways that people can save money on their mortgage if they want to save money on their mortgage? Because probably everyone does, especially if you're a property investor, you've got multiple properties. The more properties you have, even a little saving can make a big difference long term. So what are the different ways of doing that? Well, I guess the one I talk about all the time is having an offset account, because, you know, an offset account is one of my favorite things, because the interest you earn in the bank when you've got money in the bank is negligible. It's almost zero. So you're not making a lot of interest. So people that put their money in the bank, what's happening with the money in the bank is really just shrinking and getting smaller every week after week, month after month. But what you can do instead of putting it in the bank account is put it in an offset account. Adam, do you want to explain how offset account works?
Yeah, it's pretty straightforward. It's just like a savings account or a transactional account that is linked to your home loan. So it is a separate account. But every dollar that you have in that offset account is offsetting the amount of interest that you're paying on your home loan. So just as a basic example, if you have a $300,000 home loan and that's your balance, and in your offset account, you've got $20,000 in savings, instead of paying interest on that full $300,000, you're only paying interest on the $280,000. That $20,000 you've got saved is offsetting the interest you're paying on your home loan. So it's a great way to reduce your loan term, reduce the amount of interest you're paying, and save your money in the long term.
Yes, and what I suggest is what I do anyway, not what I suggest, this is what I actually do. I put everything in my offset account. You know, if I get cash anywhere, it's going in my offset account. It's not sitting in some account earning no money. It's not going into Bitcoin. It's not going to shares. It's in my offset account, and I'm accumulating it. And once that I've got enough, then I'm taking that money and reinvesting in property and then put it back in. And if people know about our rapid mortgage reduction system, which I'm not going to go through tonight because I've gone through it quite a few times, but basically by using an offset account and a credit card and putting all your pay into the offset account, and then what you do is you pay your bills on your credit card, so therefore you don't have to pay for it for another 30 days. And you get that money seeing, you literally got your bills actually sitting in your offset account each month, paying off your interest, and then you pay off your credit cards, you pay zero interest, and you're actually using your credit card to save interest. Because what happens with most people, they get a credit card, and getting a credit card is one of the worst things you can do for two reasons. One, if you've got no discipline and you don't pay off your credit card in the 30 days, you're going to pay an extraordinary high interest rate. It's much higher than your home rate. And it's really a rip-off. So you don't want to get into that situation. But two, when you've got credit card debt, it's harder to get a loan. Is that right?
Yeah, it certainly is. Any sort of liability is going to affect your borrowing capacity. And there is a little bit of a misconception around credit cards. A lot of people think that, well, I pay off my credit card every month, so the bank won't consider it, will they? The truth is they do. They'll look at your credit card limit, regardless of whether you pay it off or not. So if you have a $10,000 credit limit and you pay it off every month, your bank's still going to consider that you have a $10,000 debt. So that's something to keep in mind.
That's right. And, you know, a lot of times what I do is I'll reduce my limit right down when I'm borrowing money. And then once I get the money, then I'll push it back up again, which is pretty easy to do. Because, I've had a credit card since the 90s, and I've never, ever not paid it off interest-free. But still, even though I've got a great, 30 years of paying it off, I still have to reduce the limit because the banks don't look at that, which is funny. Yeah. So That's the important thing when it comes to credit cards. But if you're smart with credit cards, they're very powerful because you do get the 35 to 45 days interest free. And that little hook, that little thing you can use to help pay off your home loan. And really, when you think about all your bills and expenses sitting in your offset account every month for the next 20 years, that's actually very powerful and will save you, basically could save you hundreds of thousands of dollars in interest and pay off your home loan a lot quicker. And it's all those little things that make a difference. Any other ways, good ways of doing this, Adam?
Yeah, I mean, the offset account that you've mentioned is probably the number one strategy, the easiest strategy for most people to use. Only requires a little bit of discipline to make sure that you pay it off every month. As George said, put everything on your credit card. All your bills, all of your expenses, your shopping, your petrol, use that credit card. And at the end of the month, when you get your credit card bill, pay it off in full. Make sure you're paying no interest. Most credit cards now have a 45 to 60-day interest-free period, so you're not going to get slugged with interest. Make sure you don't. Be disciplined. Pay off your credit card and keep that money in your offset account for as long as possible. Get your salary, get your pay, all of your income into your offset account and reduce the amount of interest that the bank's slugging you. Just by doing that and not making any extra payments can often easily knock 7 to 8 years off of your home loan. So it is significant.
Yeah, and look, the other thing is, the other good thing you can do is you can actually get investment property. And then with the investment property, you get all your rent going into your offset account as well. Because the investment property is good debt, right? So because it's good debt, that's not really a problem. Can you hear the background noise in here, or is that okay?
Only a little bit. It's not too bad.
Excuse me. Okay. Anyway, so what you want to do is we get investment property, and then you get the rent from your investment going in to your account, and then keep accumulating more. Because what happens is each investment property you get can cut a few years off your mortgage, even if it's not positive, because the money going through is going through your offset account and sitting in there, reducing your bills. Because then you've got your other bills as well for the investment property, which you can use your credit card for. So as you build your property empire, you're creating a machine that actually works hard to pay off your loans, which is great. Because when you've got a loan, you've got to think and realize there's a difference between good debt and bad debt. Now, this is the one thing people don't realize. There's a lot of people out there, and probably listening right now, who are a bit confused about this, and I need to clarify things for people. Because there's a lot of people out there right now that think debt is bad. And I'm about to say you're wrong. Debt is good if you know what you're doing. It's bad if you're an idiot. That's the fact of it, because people get debt for the wrong reasons. And people that get debt to go on holiday, buy a brand new sports car or a watch or something like that, obviously that's bad debt. Getting in a lot of debt to get a principal place of residence is actually bad idea too. Not a good idea. And my mentor and friend Robert Kiyosaki says, your house is not an asset. It's true, it's not an asset, it's a liability. Your house is a liability because your owner-occupier, even though that's the Australian dream and everyone wants one, your owner-occupier is the biggest liability you're going to get. The most expensive and hardest thing you're going to pay off in your whole life. So what I'm saying is, fine, you get an owner-occupier, you want to have a nice house. What you need is you need to now get help paying it off, because the average person takes 25, 30 years to pay off their home off. And what we want to do is we want to help you pay it off quicker. So if you want to get it paid off quicker in 7 to 12 years, then this is what you need to do. What you need to do is you need to get help. And the best way to get help is get multiple investment properties, because each time you get investment property, you've got the tenant, the tax ban, and inflation helping you pay off that investment property, helping you pay off your bad debt. Because bad debt is your owner occupier, good debt is your investment property, because your investment property debt is a complete tax write-off. So then what we're going to do is we're going to keep getting investment properties. We're going to be funneling everything through your offset account on your home, because that's the one we want to pay off. And we want to get 100% tax deduction on your investment properties. If you structure it right, then you're going to pay off your home loan a lot quicker, and you're going to they're never going to get to creating wealth. All they're going to do is work hard, save, and try to pay off their mortgage instead of actually creating leverage, because leverage is what you need to create financial freedom.
Yeah, so off, for an SMSF, shouldn't affect your personal borrowings at all. SMSF is what banks refer to as limited recourse borrowing. Um, Quite often, they won't even use, when you're doing a property in SMSF, they won't even use your personal income to service the loan. They'll look at the income going into your self-managed super fund, so your super contributions, combined with the income from the property. So you might be getting $600 a week rent, so $30,000 a year as income through your SMSF via rent. Your employer, or if you're self-employed, you might be putting money in there, but if not, you're getting 12% per year from your income. That's at $100,000 a year income. It's another $12,000 going into super. So already with one property and a reasonably average wage, you're looking at $42,000 going into your super. That's what the banks will use for servicing when they're assessing your ability to repay the loan in super.
Okay, excellent. Lisa says, is the offset not being set up correctly? Rumours are true. How do we check?
Yeah, there have been some cases, thankfully very rare, of offset accounts not being set up correctly, in the sense that they've been linked to an incorrect home loan, or not linked to the home loan at all. Good thing is that here at Positive Property in Wells Street, we do post-settlement checks to make sure that's all done for you. What's more of an issue is not the offset accounts not being set up correctly, but they're not being utilized correctly. Using the example that George used earlier, very important to make sure your offset account is working for you. Offset accounts aren't free. They come at a nominal fee. It's anywhere between $10 a month and $300 a year, depending on the lender. So you want to make sure that you've really got all of your income going into that offset account, and you're utilizing it effectively to make sure that it's paying down your bad debt as quick as possible.
Excellent. Thank you for explaining. That was really clear. It's really good. Some expenses could be claimable as well, Adam said.
Yeah, absolutely. Not giving an accounting advice. I'm not an accountant, but a credit advisor, so I give credit advice, but absolutely giving general advice. Nearly all of your expenses regarding the home loan are going to be tax deductible for you. Certainly your interest, which at 5% a year is significant. An interest rate dropping from 7 to 6% is going to save you about $50,000 a year on a $300,000 home loan. Now we're seeing interest rates coming down even lower, which is great. So the savings are even better. Really a great time to be in the market at the moment. But yeah, certainly expenses are tax deductible. Your property manager costs, depreciation on the property, which is a big one that a lot of people miss, and your interest rate's the biggest one of all usually.
Julianne said, shame that it works occasionally, and then the offer expired and I had to pay the higher rates. There was no one to help me, so I just paid it. What was I to do? I'm not clear on that question, but hopefully she can explain it a bit more. So Harry said, do you consider points accumulating cards at all, or is this relevant? Harry, good question. I love cards that give me points, because it's the bonus plan of having a credit card. So the two things I love about credit card is, one, it gives you interest-free money that you can use. That's not yours. You don't use your own cash. And the second part is the points. I've accumulated so many points by paying off my home loans that I actually fly business class and first class around the world for free. And I love it. It's great. So having points is one of the best perks of having a credit card. Definitely. So I think it's a really good deal.
Yeah, just on that, George, as well, for anyone out there who's self-employed or a business owner, there is a really good opportunity to use your business credit card to collect points, because those expenses are tax deductibles and you're collecting points at the same time. So there are programs out there where you can pay your salaries, your rent, certainly all your bills and your expenses, stock and things like that with your credit card, and accumulate points there. It's costing you nothing.
Exactly. And it's one of those perks because what we're trying to do is we're trying to use everything to our advantage to accumulate more wealth and create more freedom. So every little extra helps, and that's what we want to do. But what we're going to do is keep in mind the most important part, because you don't want to get a credit card that's got exorbitant fees just because you're going to get more points, because then you're missing out on the whole idea of it, because what we're trying to do is save money and get points for free. That's what we're trying to do. So Harry Wilson said, is owner-occupied justifiable if covered from passive income from investment properties? That's an excellent question. Harry, that's exactly why it's justifiable. So what I suggest people to do, and this is what I did, I rent vested, because what I did is I was renting where I wanted to live and I got investment properties. And I wanted to get my dream home on the beach, which was going to cost me a lot of money. And quite frankly, I didn't want it to hit my cash flow that hard, because the fact of it is, I don't want to work extra hard. I want to have my passive income. So it wasn't until I had enough investment properties where I could live in my own occupier for free that I got my basic beach house. And then it cost me nothing now, right? And now it's on Airbnb because I've moved to Bali, and making me money. But when I was living there, it cost me zero. But if I was living there and paying for it, that would have been painful. So the whole point is you create this passive income and get all these investment properties in order to live the lifestyle you want. So obviously it's very justified and it's great. And the way I see it, if your investment properties pay for your own occupier, then I call it an investment because you're not paying it for yourself. Okay, in terms of positive, negative geared properties, which is better for tax purposes? It seems everyone thinks it's best negative geared, but why? Our properties are not yet complete, but when done, they will be positive. Good question. Negative geared, positive geared. The big $64,000 question. What I want to do is move up one level and talk about the big picture before I talk about negative and positive, because negative and positive is not the goal of what we're trying to do. Because when you think about investing in property, we've got to think about what is your goal, because sometimes people get caught up on the details and don't get the big picture. So in our program, the Positive Property Markoski Method, the goal is money for life. What does money for life mean? That you're going to create a passive income, and your number one goal, if you haven't done this, because that's the number one thing you can do to create freedom in your life. Whatever you make a year, whether it's 80,000, 120,000, 150,000, imagine if you had a property portfolio that paid you that much every year and it went up 5 to 7% every year going forward. Would that give you freedom? Type in the chat if it would. What would it do for you? Would that give you freedom? That's the number one goal. So the goal is to create money for life. How do we do that? Well, we have to buy properties that are going to go up in value, because if you buy a property that's not going to go up in value, no point. So in order to have money for life, you can't just buy any property. You've got to buy properties in the top 100. You've got to buy properties that are consistently going to double every 7 or 10 years, over and over again, because you make the cash flow from the capital growth, not the other way around. So do you get negative geared or positive geared? It doesn't matter as long as you get a property in the top 100, because negative geared and positive is just about structuring. But usually if you want to get a property that's going to be high growth, it's going to be negative at the beginning. That's the fact of it. Because if it's positive at the beginning, then there's not a lot of competition for that property. There's no competition for that property because it's not a good property. It's not going to go up. And that's why it's a bigger return at the front. So what we do is get a property that's slightly negative at the beginning. That changes very quickly. And then it becomes positive. And that's the way we work it. But, usually what I want to do is I want to make money on paper, lose money on paper, make it in real life. And that's what you can do as well.
Yeah.
Where you can make money, but lose it on paper.
Mardine's is positive because she had a cash deposit.
Yes, there you go. Fantastic.
Yeah.
And that's good.
Yeah.
There's nothing wrong with that either. It's good. So if you had a loan for your main residence and get another loan for investment property, they give you an offset account per loan for each property. Are you best to only use the one offset that is linked to your main residence, the bad debt, so that all the investment property revenue incomes to reduce the bad debt one quickly before starting the next properties. That's Anna Tuttle. And Anna, little clap.
Yeah, a good one. So you're depending on whether you've got a good accountant or not, you might get different advice here, and depending on what your goal is. So everyone has different goals. You're looking to pay down the bad debt on your owner-occupied home, which of course you can't deduct as an interest expense. Then the ideal would be to put all of the money into the offset account linked to your owner-occupied home loan to pay that down as quick as possible. Once your house is paid off, then great, you can use the offset account that's linked to your investment property home and start paying that down quicker as well.
Exactly, because there's different phases, right? And what we're doing is we're accumulating money in an offset account for a principal place of residence. But during growth phase, what's going to happen is as we accumulate, we're going to find more property, pull money out, and going backwards and forwards. And then once we finish growing our property portfolio, then we get stuck into paying things off and quickly. And that's where we start smashing the loans down. And that's exciting too. And once you've paid them off, then you're going to have a lot more income as well. So, but really good that Anna understands the principles and worked it out, which is great. Fiona, so the property you own in your SMSF, you must have the rent paid into savings account attached into this SMSF and not your personal savings account.
Yeah, that's correct. You generally have to set up, and your accountant will help you and advise you with this, give you qualified advice, but generally you'll have a bank account that will be in the name of your SMSF, so a trust associated with it or a company, depending on who the trustee is. So you will have an account that is in the name of your SMSF, and that's where the income from your SMSF property will go into. It won't go into your personal account.
Yep, because SMSF has to be completely separate from your real life, otherwise you get in trouble. So Brad asks, can you claim any travel, etc., if you have homes in different states? Unfortunately, Brad, back in, I don't know, just about 5 or 6 years ago, they changed the rules because you used to be able to go twice a year to visit your investment property, but they changed the rules and now you don't get any tax deductions for visiting your investment property, which is a shame. Because I remember all our clients used to buy properties in Queensland that were going up in value and have 2 free holidays every year, right? Which is great. But unfortunately, no. Adam says, with owner occupier, is it best to pay off the loan or keep it active with a 200,000 loan and 150,000 offset for deposits and other? Good question. I like keeping things active. I don't like paying off loans because once you pay off a loan, if you want to get that money, you've got to do a whole heap of paperwork. But if it's active, you can just take the money out. Any ideas on this, Adam?
Yeah, again, it comes down to your mentality. If you have an investment and a growth mentality, and you've got $150,000 sitting in your offset account, that's great that it might be saving you 5 or 5.5% interest on your home loan. That's a laudable thing to do. But the reality is that $150,000 could be working for you because you can magnify that income. $150,000, depending on your servicing capacity, of course. You might be able to get a $700,000 or $800,000 property with that $150,000 deposit. That property is not only going to go up in value and double every 7 to 10 years, but it's also going to provide you with further tax deductions and opportunities for growth. So, yeah, if you've got money sitting around in an offset account, I certainly, from my personal perspective, I'd be looking at investing that and make sure that money grows, leveraging the $150,000 to buy a $500,000, $600,000, $700,000 property and build my portfolio.
100%, Adam. Totally, exactly what I would say. So you know your stuff, which is good. Ben said, so George, should I move out of my owner-occupied property and rent it out? Ben, that's a complicated question, and it depends. One, you got to think about lifestyle, and you got to think about, your own occupier, is it in a convenient place? If you're renting your property out and you rent it somewhere else, would you be making more money or less money? That's the questions you need to ask, because it all comes down to the numbers, and are you going to get to your goal quicker by moving out or slower? And that depends on your own occupier. It might make you, if you're moving out, might get you to your goal quicker, might get you there slower. So you need to do those numbers and maybe talk to your coach. If I own my home, how much equity should I pull out to use to invest? Okay, I'm happy to answer this one. As much as you can, whatever the banks let you do, right? What we want to do is your equity is literally sitting there doing nothing, right? There's no benefit in having equity. but you can actually use it. So what I would do is I would actually book in with Adam, right, in your calendar, which we're going to open your calendar later, and say, okay, let's get all these different chunks. Because obviously, Adam, when you redo things, you don't just take out one big lump. You take out different buckets for different investment properties, and we get as many buckets as we can. So therefore, they're all quarantined because we don't want to mix them all up, and then we can slowly get investment properties one at a time. Would you like to add to that, Adam?
Yeah, no, that's spot on. If you had the equity available, we can literally split the loans into separate portions. So let's say you can afford 3 investment properties at this point in time, and you have the equity to do so. We'd set up 3 separate equity release loans to be used as deposit on the purchase of those investment properties.
Mm-hmm. Yeah, absolutely. Darren said, how to pay off your investment loan on interest only with offset. So Darren, an offset account and a bank account that you pay is almost the same thing. When you pay money into an offset account, it's like paying principal to the bank, but it's principal to yourself. Is that right, Adam? You've got to think about it that way.
That's correct.
Because if you owe 100,000 and you put that 100,000 in an offset account, you've paid off your loan literally because you're paying zero interest. It's the same as paying principal. So, and also interest only loans only last 5 to 10 years anyway. So you're going to be recalibrating and doing it. So you can pay off your loan with interest only. It doesn't matter because the excess money you've got has to go somewhere. And that's why I see it. Because a lot of people have been brainwashed into paying principal. And there's no point in paying principal until you move to that phase of your investment journey where you're paying off your loans. Because paying principal is paying off your loans. If your accumulation phase, you don't want to pay off your loans when you're accumulating because it's too hard to do. It's a bit like if you're going to the gym and you're bulking, you can't shred at the same time because it's not going to work. You're either bulking or you're shredding. You can't do both. So when you're accumulating property, don't worry about paying off your loans because your properties are going up and inflation's shrinking the loans anyway in the meantime. And once you're ready and you've got enough investment properties, you've got all this money coming in to pay off your loan. It's going to be very easy. You on your own trying to pay off your loan is stupid. You know how many people I get, that hear about that I do property? And the first question that goes, George, help me get out of debt. And I'm like, I'm going to help you get into debt, but good debt, right? If they should be asking me another question, they'd be saying, George, help me get into good debt. That's what they should be asking, not help me get out of bad debt. Now, Melanie, she said, good question. Yes, was thinking of redrawing from ours for another property. Melanie, high five. You should do that. Great idea. Get another property, make more money. Lisa said, we learned that the hard way. Is there a limit on how much you can have in your offset account?
No, there's not. You can literally be positive in your offset account. No limits whatsoever.
Yeah, but I don't know if it's any point because I think once you fill it, what you want to do, you fill your offset account to the brim and get another offset account. No point at all.
Yeah, you'll find that most lenders will. Macquarie is a great example. If your offset account is in positive territory, if you have credit in your offset account, they will actually send you a message saying you have money sitting there not working for you, and advise you to move it to an account or do something with that money rather than just have it sit there and not earn you any interest.
Yeah, exactly, which is great. But really, the good thing is when you go to Wall Street, they're going to keep an eye on what you're doing because they're going to, Adam and the team are going to be reviewing you every 6 or 12 months to see what you're doing and help you move forward. The beauty of having a professional like Adam on side is then you don't have to worry about all those little things that you normally have to worry with when you go to a bank or just someone, when you go to a mortgage broker that doesn't understand investing. See, most mortgage brokers, they know how to write loans, but they don't know how to invest. A lot of banks, they're even worse because all they want to do is give you a product that is at the bank. They don't even want to shop around. So when it comes to investing, one of the most important partners you've got in your investment journey is a mortgage broker, mortgage manager that knows your system of how you want to invest, right? And knows about investing and can really think about all this deeply and understand it all better than what you can. Because if you're telling your broker how to do things, wrong broker, not good enough, right? And that's part of the reason we've got Adam here, because Adam understands the positive property way, the Markoski method, and he understands investing. He's got the experience to make it easy for you, to make sure that we get everything right for you, because you want to get everything right. Because Is it going to work if you get a few things wrong? Sometimes, maybe. But to use this system that we've got with positive property, you know, if you want to get 10 properties in 10 years, create financial freedom, replace your income through property, you want to use every single thing we've got in place to get you there the quickest way, right? You don't want to have a Ferrari with a flat tire trying to get to your destination. But someone like Adam and the team are going to help you and make sure that everything's working well, the engine's working, the tires are pumped up, and we get you to your destination the quickest, easiest way. Right. Do you reinvest when your investment period comes to an end to avoid start paying principal? Mark, we'll probably do it before then anyway, because we're reviewing every 6 to 12 months. Can you extend an interest-only construction loan?
Yes, you certainly can. Interest only is the base level for a construction loan. It's automatic. Once the construction is complete, most loans will switch over to principal and interest. We don't want that. We'll usually set you up with an interest-only loan from the start, so for a period of 5 years, and that way you don't have to worry about it.
Yep. Is it better to pay into the refinance loan offset or the owner-occupier offset?
Yeah, again, depends on your goal and whether you've got an investor's mentality. Paying off the two advantages for both of them is you're paying down the interest, but realistically, you want the interest deduction in your tax from your investment property. Like George was mentioning earlier, you don't want to be paying principal interest on investment home loans. That principal payment could be used to be growing your wealth by paying off other properties. So absolutely not. I would suggest that that's the way to go.
Yeah, excellent. What I want to do now, before we close the live session, because what we're going to do is we're going to go into our private group. Before that, I just want to go through a few wins, because that's always exciting, and then we'll go to a private group. Because I love sharing wins. Real people, real results. This is actually a photo of one of our events in Adelaide when everyone came along. Very exciting. They keep getting bigger every year, which is very exciting. Okay, Janie. Janie joined in September 24, but couldn't act. She was uncertain, hesitant, stuck. Then recently she re-engaged and set up an SMSF and took bold action. She got an apartment in ACT, and now she's a yellow investor with 2 properties and rising. Well done, Janie.
Janine's here.
Janine. Oh,
Yeah.
Okay, here we go. Hi,
Have a
Janine.
chat to her.
Hi, Janine.
Hi, how you going?
Good, well done. Talk to me, what was the breakthrough with you and getting onto that second property?
Look, I'm a single parent and struggled for a long time. My brother actually got me onto you guys, and I was hesitant, scared, thinking how I'm going to do it. It's too hard, it's difficult. But with the help of Michelle and Billy, and then of course Aidan and Brittany from Well and Count, I got through the scary part, and got an apartment in Canberra. Just actually the tenant moved in today.
Fantastic.
So,
okay, when did it settle?
Only Monday.
And you got a tenant already?
Yes.
Not bad at all. Pretty good.
Positive property organised all that, and the tenant moved in today.
Well done. So your brother, is he part of the program as well?
Yes.
Oh, there you go. That's really good to get a recommendation from your brother, and now the sister's
Well, he was actually he went to your Adelaide conference. And
he did? Okay.
As soon as he came back from that, he gave me a call and knew I was worried about the future and, trying to raise kids on your own and working. And, I jumped straight in from there after a consultation with Belinda. And, there's been ups and downs, I'll tell you that. And a bit scary when, you really don't understand everything that's going on. But I credit to Positive Property. That's where they came in the picture and really helped to get over the line.
I'm really pleased that we helped you get over the line. I'm just curious, there's other people that are hesitant and scared. What would you say to them? Because, it's very normal to do that, to be like that.
Oh, look, I think everything in life, when it's scary, you back, but you've got to face that fear and do it anyway. And the way I looked at it, I could look at the next 10 years and say I'm exactly where I am now, or I can look at it as a long-term strategy in 10 years, be financially free, which would be the best thing ever, and have a legacy to leave to my children as well as a single mum.
Look, I just want to say well done for having the courage to step up into your power and do this and become a property investor. Excellent. I look forward to watching your journey along the years.
Well, so do I.
Excellent.
Congratulations, Janine. You've done so well. Like,
No, thank you, Michelle, for
amazing.
helping out and putting up with me with all the questions.
Let's pull Michelle up as well. Let's have a look at Michelle. Here we
No,
go.
this has been an amazing story because Janine wanted to leave the program at one point.
Oh,
Yeah.
really, Janine?
Yeah,
Oh.
I just didn't think I could do it. I just thought there's no way I can do this. And, you know, I had to go to a self-managed super fund. So that was all a big movement and a lot of things I didn't understand. And Michelle was on my case and keeping me calm and reminding me and bringing me back down to earth and coaching me on. And yeah, and now I've got my first property. So I'm really happy.
Well done. And well done, Michelle, because look,
Yes.
at the end of the day, investing is not easy. That's the fact of it. And it's not a straight line. There's a lot of work to get up there because if it was easy, everyone would be doing it. That's the fact of it. And that's why having a coach is really good to just get you through the hard parts and get you over the finish line. Because if you don't get across the finish line and get that investment property, everything you've done has been a waste of time anyway, right? So that's the thing. But you went through your hurdles, you did it, and now you're there. And the fact of it is, you'll be thanking yourself in the future because if you look at what's happening in the world at the moment, in 5 or 10 years, people won't be able to get properties anymore. That's the way it's going. In America, the average person spends 50% on accommodation. They aren't getting any investment properties. In Australia, it's 30%. In about 5 to 10 years, will be 50% as well, like the States, unfortunately. This is our last opportunity to create freedom. And the people that get property now, it's going to be, when people look back, they're going to go, oh my God, you were part of that generation that could get properties. How exciting, you know.
What rent are you getting out of interest?
What
Sorry?
rent?
Yeah, for your
It's
property.
it's $460 a week. I think $460.
Yeah,
So-
that's good. Yeah.
But yeah, no, I have to give credit to Michelle. She's put up with my tears and my stupid questions, everything that I thought was stupid and you know, not worthy and whatever. And she's really helped me along. So thanks, Michelle.
There's no
Michelle's a
silly
good
question.
coach. You know, the coach is good. Okay, let's move on to our next one. Let's go. Have we got another one? Okay, we got Jane. Joined in January 2024, couldn't borrow a cent, self-employed, living in the UK, juggling life, sorted the tax, sold a Burwood unit, and worked extra jobs to build funds. And now she's approved, contracts in for Mount Barker and ready to expand. Orange Belt investor, 3 properties and growing. Discipline builds destiny. Is Jane here as well?
No, she's
Who's the
not.
coach? Oh, that's okay. Anyway, I'm really proud of Janine and Jane. Thank you. Well done. And now, everyone watching us live, we're going to have to switch off now. But what I want to say, if you want help, you want to pay off your mortgage quicker, you want to invest in property, type in #invest. My team will reach out to you. We're going to be here again next Thursday. And Adam and I are going to go into in our group. Thank you.